Welcome to everybody this evening. My name is Don Kaufman. You are watching a TheoTrade presentation, How to Survive and Thrive in Volatility. All right, risk disclosure. We are not financial advisors nor a broker-dealer. Some of you might remember I worked in the brokerage business for quite some time. I'll discuss that here momentarily. Next, copyright disclaimer. It's mine. It's not yours. This belongs to TheoTrade. If you need to get a hold of me after this evening, just go to support@theotrade.com. I always make mention of this. I'm going to make mention of it again. Listen, we want you to be able, to contact us, including myself. This is not like, the one-trick pony over here. You need to get a hold of me. Just shoot me an email. Put Don in the heading, all right, in the subject. Put Don in there. Believe me, it goes directly to me. We get thousands of emails a day. We can handle it. That's what we're here for. All right, next up on the agenda, I think it's important to know why you're here. Why are you here? All right, and I think it's a fair question to obviously ask. Why are you here? Listen, we want you to be able to walk away tonight, usable, tangible information. So you're going to learn a little bit about volatility, why it equals risk. And you got to learn to handle that for success in these markets, okay? You got to learn what works in volatile markets so you can profit from volatility. Obviously, that's a big one. What works in volatility? Number 3 on the list here, discover how to build trades with limited risk and maximize returns. Limited risk is going to be critical because if you have not watched for a little bit over a week now, you can get your head taken off here in 5 minutes. If you don't like the weather, don't worry. It'll change 5 minutes later. We're also going to talk in detail about implied volatility and how to use that implied volatility, the knowledge of implied volatility to increase your probability of success in this marketplace. This will make a lot more sense here momentarily. Again, we have a tremendous amount of information to go through. For those of you, if you stay with me to the end of this webcast, I believe we have a very nice gift for you. The gift, it's a $297 value, okay? I want everybody to have this, okay? It's the cumulative ticks, okay, and quad indicator. And I'll explain it real briefly here. Cumulative ticks provides a running tabulation of the New York Stock Exchange tick indicator, right? And can provide leading edge insight towards a shift in market direction. I'll actually give you a screenshot here, but I want to reiterate this again. Hang with me right until the end of the webcast. At the end of the webcast, I'll actually provide you, okay, a website where you can go ahead and download this particular indicator. This is an indicator, that it's very quantitative in nature. I think you guys will absolutely love it. This is actually what it looks like. I'll give you the details, the specifics over here. Okay, when I say it's a quantitative indicator, what it's actually doing is tabulating, ticks. There's upticks and downticks. For the most part, what it's telling you, are we getting accumulation of sell side activity? Even if the marketplace, starts to make a flying move to the upside, these ticks were accumulating negative all day. And even though you saw this big break to the upside in this particular trading session, right? You got that big break to the upside. The ticks actually weren't buying it at all. In fact, they started to sell, and you got the marketplace that dove back down. By the way, that day was right there. It was February 27th when I actually took that screenshot. In addition to it, there is tick data, advanced decline data, all right, breadth data. All of it is actually found directly on this. It is a phenomenal indicator. I think you guys will really enjoy it. All right, onward and upward. A little bit of housekeeping before we get off and rolling into our education portion of this. This is a skill set that you're going to be learning tonight. I'm going to go through a huge amount of material. I say shut the door, turn off Skype, chat, whatever else distracting you, close Facebook, silence the phones, kick kids out, grandkids, whatever it takes. Pay attention. I'm going to move fast, right? And I got to move fast. It's a huge amount of education I'm going to pack into here. If you guys don't mind, I'm probably going to run a little over an hour tonight. I'm probably going to run closer to 90 minutes. Hope that's okay with everybody. So sit down, tune in, turn on. This is about to be Mr. Toad's wild ride. Again, focus for the next few minutes. Listen. I watched order flow for 15 years. It's a big portion of why I am here. So background information. I grew up around traders. When I say grew up around traders, I had family that traded at the Chicago Board Options Exchange all the way back to the 1970s. So growing up around it and watching them make, well, a lot of money. I had an uncle that owned over 500 seats in exchanges worldwide. He built a very large, one of the most successful firms ever in Chicago. It was called O'Connor and Associates. Anyway, I got invited in the late 90s, 3 weeks out of college. I did not do a degree in finance. I did a degree in molecular genetics. You want fries with that? So in the late 90s, I got invited just to clerk on a trading floor. You put a 22-year-old kid in a trading floor, I'm sold. I traded down there for a couple of years before I got an offer from a startup company. I got an offer from a couple of guys I knew on a trading floor, and I went to work for them. And that company became what we term Thinkorswim. If you're unfamiliar with Thinkorswim, I started there in 2001, about 3 years into my trading career. And we built Thinkorswim, took the company public in 2007. I went through and then I was there with the buyout by TD Ameritrade. It was a wonderful ride. I actually ran the education division. Initially, I built the education division of Thinkorswim, which is a complete separate subsidiary. Then I went on to run TD Ameritrade's education for a period of about 5 years. And one of the things that I think is important to you, I had access to the largest retail order flow in the entire industry. Effectively, what order flow means, I could see everything that you did, and I studied it. Okay, my entire group studied it. In fact, we had access to people that are like actuaries and so forth that would write algorithms to be able to study trades and trade ideas. A lot of big data. There were hundreds of thousands of clientele there. 7 million TD Ameritrade clients, but hundreds of thousands of people that traded options. We studied all of their trades, and what you learn from that. Well, you're watching billions and others' mistakes and the knowledge of what works best for retail traders. That's a little bit of my background, and a synopsis there of about 90 seconds. Done a couple of TV programs over the years. This one's just in studio. This is actually TD Ameritrade TV. If you're unfamiliar with it, that's fine. This happens to be what you're probably more familiar with, CNBC. Okay, that's myself versus the hedge shark himself, Mr. Wonderful. I was actually on the short side of Apple. He was on the long side of Apple. Worked out for me at the time. With that, let's get right down to it. Do you want to thrive in volatility? I think it's a fair question because you came here tonight in order to learn to be able to make money in the midst of what we term the extreme. And we're going to get that done. Before you do that, and just put on the brakes for a second, okay? If you are going to make money in this business, in the marketplace that we're in right now, okay, does that sound reasonable, okay, to everybody? Yeah. By the way, these are not rhetorical questions. I don't care if you're, watching this late at night by yourself, all by your lonesome. You should be yelling at your screen. I do all day. even when I don't have a microphone in front of me, I just yell at the screen all day. It works, okay? But if you want to learn to make some money in this marketplace, right? There's two critical components that you have to address first. And this is something like people don't want to do the work. They just want to be I just want instant coffee, instant tea. Show me the flashing red and green arrows that are going to tell me what to do. Okay, here's the critical components. Before you can move forward, okay, and get anything going in the extreme. And forgive me for saying this, but was today extreme? Huh? I question that. Was today extreme enough for you? Because if you didn't like, today, and I'll just show you when I'm saying was today extreme enough for you, not everybody here necessarily watches the marketplace on a day-to-day basis. Not everybody here is watching that the Fed came out. That's a 1 minute candle. 1 minute. The S&P 500 moved, let's just call it 3060, okay, to 3130. For the most part, you had a 70-point move, in the S&P 500 in 1 minute. That's a 1 minute candle. Yeah, I think that qualifies this as a little bit nuts, right? Before you can move forward, what's mission critical? There's critical components in navigating volatility. Two different critical components. You got defense, you got offense. First thing you have to learn in this business, control the risk you have on. Here's the bottom line. If you can't handle the risks that you currently have on, you have zero chance, no chance to profit from the onslaught of volatility. And I'll reiterate that 100 times over. Now, some people are going to tell me, Don, I don't have any risk on. And I say to you, yeah? Are you going to trade in this marketplace? And they go, well, yeah, that's the idea. Okay. Well, you know what? If you're going to go on the offensive, you have to have some defense. You better understand, okay? You better understand the risks, even if you're going to be putting positions on. So we're going to cover a little defense first, and we're going to go to the offense. What is offense? You got to be able to place viable, defined risk strategies designed for the extreme. They have to be designed for extreme. You can't, people, it's a strategy for all markets. No, it's not. Like, are you crazy? There is no, there's not a strategy for all markets. There are strategies designed for extreme volatility. And you should also note that extreme volatility is the single greatest wealth creation mechanism the markets have to offer, bar none. If you ever hear stories, okay, and some of the most famous trading stories, they all revolve around one aspect: huge volatility and somebody knocking it out of the park. Now, some of the names that I may mention, okay, people don't necessarily, love, even like Bridgewater, the largest asset managers in the entire planet, okay? Yeah, they're also started off as a crisis-seeking fund. Basically, what they were doing, looking for extreme volatility. I mean, I can go on and on and on all day, okay, about all like the marquee traders out there, all looking for the exact same thing, the extreme, because the extreme, that's when it opens up opportunity. But before I go into either the defense or the offense, I want to show you what's possible. Okay, first, what's possible in the extreme. Now, look, this isn't a shot of a 5-day net lick. What net lick is, it's my net liquidating value. Okay, this just happens to be a portion, okay, of last week. And the way this works, okay, it works backwards. This is the 23rd. I believe that was a Sunday. That's a Monday. That's a Tuesday. It's a Wednesday. It's a Thursday. Okay, I took this screenshot last Thursday because I want, let's be realistic. I don't want to, this, by the way, this is an IRA account. This is not some fictitious beast out there. It's an IRA account. On a Sunday, it was sitting at 211. By a Thursday, it was sitting roughly at 250. So it's about $40,000 in an IRA. And again, it's an IRA. So I don't want you to think this is, huge amounts of margin. Okay, there are 0 futures contracts traded in here. That's what's realistic in the midst of volatility. By the way, today is a volatile day. So why show you last week? Let's just cut to the chase. This is actually the Thinkorswim from TD Ameritrade platform. I still use it. Okay, I don't know for how long, but I still use the platform. And if you're curious, how did today shake out? I have a lot of positions on. Don't let this intimidate you. All of my positions accumulated together. If you take a quick glance down below over here with me, okay, that's my margin. And I want to make clear, this again is an IRA. This is a retirement account. It's my IRA. It's my margin, and my margin is precisely $45,000. Now you saw me, I made like 40 grand last week. Today, $8,107.50. Okay, because people want to know what's possible. Okay, what's possible? What's plausible inside of some extreme volatility? I think that's not only plausible, it's pretty much every single day last week. The kinds of trades that I'll do in there. Okay, this is actually a fun one. I wanted to take a screenshot of something today, something that I did today, and that's this. For those of you, if you've never actually seen a screenshot like this, okay, what you're actually looking at over here, right there, obviously today's date, that's the exact opening time of the trade. I'm on Mountain Standard Time. This is obviously the date and the closing time of the trade. So I opened a trade at 8 o'clock in the morning. I closed it basically right before the close. I opened it for a limit price of $6.76. I closed it for $15. For the most part, every $676 I invested, I got back $1,510. It's 123% return. Okay, all I did in this particular case is what I term sell the Fed. And if you're curious on this particular trade, in terms of the time, I waited. The Fed came out. The Fed actually said something. Look at the exact time. Okay. All right. And again, if you wanted to see the time of the trade, 8:06. Okay. I waited for the Fed to come out. Okay. I saw the huge move up, and here we go. 8:06 right there. I actually executed, and I rode the marketplace down for the remainder of the day. I mean, that's what you can do in terms of volatility. That's not everything. Okay. These are some volatility trade examples. I'm going to explain this a little bit later. This is actually specifically from last week. This is a strategy that I use all the time. It's called a risk twist spread. It's actually part of an infinity spread. I opened it for roughly $1.80. I closed it for a $10 credit. That's every $180 I invested. I got back $1,053. It's a 485% return. By the way, this doesn't have to be, okay, 180. It can be what? $1,800 invested to return 10,000, okay, 530. You can go further than that. You want to keep adding zeros in there? Go for it, right? It is an absolute grand slam in terms of a strategy to use in the midst of volatility, okay? Moving forward, this is actually another one. By the way, all of the trades that I'm showing you, and I want to be clear about this, all the trades I'm showing you, okay, come from, I do have multiple accounts over here, okay? The account that I predominantly trade in is my IRA. There are absolutely, again, no futures contracts being traded in here right now. There's nothing wrong with futures. I just want to show you that I'm not heavily leveraged, okay? I still have on, like this XLU risk twist. That thing is up 300%. I have not closed it, saving it for a rainy day. And we're going to move forward from there. By the way, all the trades that I'm talking about, okay, are coming directly from this account. These are my trades. Okay, for better, for worse, these are the trades. I can even sort. Here's the risk twist spreads. You can see them in here, right? Like all the different spreads that I've done are right in here. Ready for another one? Okay, this is the XLF spread. $36. Every $36 I invested, I got back $135. Or it could be $360 I invested to get back $1,050. It's 275% return. Again, I'll show you this a bit later. Last but not least, I got a VIX volatility spread. The VIX volatility spread, what this amounts to, I paid nothing for it up front. I got a $3.75 credit. Okay, these are all home runs specifically because of heavy amounts of volatility. It's just, listen, those type of trades, it's up to the plate every single day. And I wanted to show you that. That's why I started off with this initial trade here about selling the Fed, because that's only going to get better. And when I say it's only going to get better, the volatility here, we're not done by a long shot. I can talk about that a little bit later here. But in volatility, defense first. Now, let's not get giddy just yet, because that's the way it goes. People get giddy with volatility. Yes, it can produce returns. That's why I wanted to start with that. But number one, you need to understand your risk first. And you have to be capable of controlling the positions that you have on. If you're running from risk right now, you're in trouble. Okay? You have to realize that your money's on the line. I mean, how you handle your risk is going to be correlated to your success in the markets. And too much risk, and what are you going to do? You're going to panic. You're going to close positions continuously at the worst possible time. May I ask the question? Okay? Anybody here panic and close the positions, for instance, last Friday, only to see the marketplace explode to the upside on Monday? Come on, people, admitting it's the first step tonight. Come on, who barfed up last week? Who did it? Who panicked out last week? Right? It's okay to admit it. Like, I'm the only one reading it, you know, and the yeses are pouring in. That's okay. All right. And this week too. Listen, there are things that I can tell you about this marketplace. One of them I'll tell you, I have actually watched from behind a screen. Okay. I want you to imagine this for a second. I am behind a screen. I could watch for 15 years every single trade that came into Thinkorswim. And then from 2010 to 2015, I could watch every single trade that came into TD Ameritrade in real time from behind the screen. I'm going to tell you right now, I know exactly what goes on. Okay. And you see it again and again and again and again. But people, you're so consistent with your panic. It's ridiculous. So before we go any further, we're going to actually talk about that risk. We're just going to be able to get a handle on it, right? What can implied volatility do for you? One of the first things I want to cover tonight is implied volatility. If you know what it is, great. If you're not, here comes a crash course in implied volatility. Are you ready? When I say a crash course in implied volatility, yeah, I'm going to run through this kind of fast. Okay? And that's okay. Because again, some of you already have a handle on this. If you're brand new tonight, sit back, grab big concepts. All right, here's a stock. This is a stock, and the stock is trading right smack at $100. And that stock has a volatility of 20%. Now, where does that volatility number come from? It comes from something called options. Now, I am not here to bark at you about options all night, or you need to trade options. I am here to tell you something about options. Options okay, give you one critical aspect that I think you need. And people miss this. Options actually tell you volatility. You're like, okay, so what is volatility? Come on, what is it? Anybody? What is volatility? People go, it's stock price movement. That's part of it. It's risk. That's part of it. Okay? It's all part of it. What volatility is, you think of movement. Here, this volatility says 20%. A lot of people, they look at volatility, or they look at something called the VIX. If you look at the VIX right now, I think it closed about 38 today. If you look at the VIX, it's 38. What does the VIX really tell you? Okay, well, I'm going to explain that. Here's a volatility of 20%. What it really means is that this stock, what stock is this? This stock could be anything. It's called stock. So this stock, this $100 stock, can move up, okay? What, 20% or down 20%? That's what it really means. What's 20% of 100? Okay, it's plus or minus 20. That's actually right there what this volatility means. That's what that volatility means. Okay, it's supposed to say, hey, listen, when you see a volatility, and I want to make this really, really clear for you guys, but when you see a volatility and that volatility says, okay, roughly 20%, it just simply means the stock can move up 20% or down 20, and it's supposed to stay in that range, okay, 68% of the time. People go, what? All right, 68% of the time. What is 68% of the time? It's one standard deviation, right? Everything you do in your life can fit into a deviation curve. Everything you do in your life. You take a test, you're either at the upper edge of the curve or the lower edge of the curve. You drive a car, are you a really, really good driver or a really, really bad driver? Or are you from California? Oh, that wasn't even fair. I mean, but most of us fit into the meat of the curve, right? So that's what standard deviation happens to be. But here's the cool thing about this, and I just want to make this clear, all right? So this thing is supposed to stay in this range between now and 1 year from now. 1 year. I know that actually says 1 year. Okay. Now and 1 year from now, it's supposed to stay in that range. Who cares what's going to happen in the year? I'll be dead in a year. Right? That's what most people think. I want to know, okay, can I figure out how far that stock can move in a month? I want to know how far that stock can move every single day. Can you extrapolate that specifically from options? I always want you to remember this. Can that be extrapolated from options? Absolutely unequivocally, yes. Okay, you can do that. Let's do it right now. Before we go any further, I'm just going to cut to the chase. Let's get to it. I'm actually going to show you where this exists, and I'm going to show you how to do it on your own. Okay, name a stock. You guys tell me a stock. I don't want to bring up. I'm going to wait until symbols start pouring in over here. Okay, I don't care. Give me a stock. Apple. Oh, I've never heard of Apple before. Oh, great. We already have like 10 Teslas, a couple of NVIDIAs, an Apple. Okay. By the way, I said a liquid one. Actually, I didn't say that, but I meant to. All right. Some stock that, people have actually heard of. Oh, I like this one. AMD. Somebody said AMD. Okay. If you don't know AMD, I don't care. It's a $46 stock. It doesn't matter what stock it is. Okay. I want you to look the next 3 days. All right. In the next 3 days. What's the next 3 days? Who cares? It's the next 3 days. So what is this? It's Wednesday, Thursday, Friday. Look over here. Do you see that where it says plus or minus? That says plus or minus $4.50. Do you know what that means? Okay. That means if you put this on a distribution curve, it's supposed to move up 450 or down 450 and stay in that range, what? 68% of the time. Welcome to the party. That's called expected move. Welcome to the party. People go, what? Listen, we take options, we extrapolate to stock price movement. Let me show you. What does implied volatility do? Blah, 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 blah. What can you use implied volatility for? Like, what can you use it for? I told you that when you came in here tonight, that you had to leave here with something tangible, something real, something right now. This is expected move. What we're going to use is we're going to use option price to extrapolate stock price movement. Why? Because right now, okay, you are blind. People all the time, like they don't even know what an option is. They don't even know what an option is, and they trade in this business. How can you do this without looking at the option chain? The option chain is depicting risk. And you go, how accurate is that? It's dead accurate. Dead accurate. Do you want to know how accurate this is? Okay, I want to show you exactly how accurate it is. Because in the S&Ps today, And again, I don't mind doing this. In the S&Ps today, there's an expected move that we actually use inside of the SPX. What's the SPX? It's the mother of all products, big and small. Whoops, swing and a miss. It's a mother of all products, big and small. And I just want to zoom in for just one brief second to this. You want to see how accurate the expected move is. You see that right there? Okay. What I drew on my screen on this chart, that's the edge of the expected move. Do you know that in the midst of today's crazy, insane move by the Fed, that we stopped at the upper edge of the expected move and pulled right back? Just wanted to show you that, because if you don't think expected move is important, you're missing the bigger picture in this entire business. What expected moves do is they tell you how far the product, what's a product? It's a stock. It's Apple, it's AMD, it's Microsoft, it's Moo, it's Boeing, it's Netflix, it's Uber, it's Tesla, it's XLU, it's Nvidia. Okay? It tells you how far that stock can move within a given period of time. Here, expected move and probability. What it basically does is says there's a 68.3% probability of an underlying closing inside the expected move. But there's a reason that I'm teaching you this, okay? This is expected move. Again, you can figure out the expected move for what? For 11 days and 13 days and 15 days and 18 days and 20 days and 22 days and 25 days and 27 days. You can figure out how far the market can move with all those time frames. Timeout right here. Does that information help you? Because some people know about this and some people don't. Does what I just gave you, okay, for a brief and fleeting moment, took us 5 minutes to go through that. Does that help you? Does it help you to be able to quantify risk? Because you're going to see in a second, you're going to be like blown away. And there's a lot of people, again, they don't want to look at options. And I'm not here to drill you like you saw a moment ago. Evidently, I trade options. I'll trade anything as long as it's fair, meaning that it has to have a clean market. I'll trade anything. I don't care. I'll trade stocks, options, futures. I just don't care. Okay, because in the end, all these products, all you do is buy them and sell them. People get all out of whack with options. Like, there's this trade called a risk twist. It's an infinity spread. It's a mambo combo. It's a triple naked backflip twist trade. Who cares the name of it? In the end, you could buy it or you can sell it, and it doesn't make a difference. But in this case, I'm just using options to help you gauge your risk. Listen, expected move. And not every trading application has expected move. You can use what's termed an at-the-money straddle as an alternative. Let me show you what that means, okay? This is a stock, okay? And let's say that the stock is trading right at 128. This is a put, this is a call. Add the put to the call, add the put to the call. What do? Add them up. What does it equal? $10.78. That's basically the same thing as expected move. Okay, you're like, what? Slow down. Okay, watch. We'll go over to a trading application. Let's name another stock. Somebody said Tesla. Okay, Tesla. Has anybody heard of this company called Tesla? I heard they make kind of cool cars. They don't make cars. Okay, they make toaster ovens that go from 0 to 60 faster than a Lamborghini. It's just a toaster, okay, that you really don't have to plug in. But Tesla, let's just use the next 17 days. I want to show you how extreme this marketplace is. Okay, in the next 17 days, you're looking at a $147 move. $147. Now, time out. That should intimidate you. That's why I'm showing you this. Are you intimidated? You're like, yes, I got sick. All right. That's the way you should feel. Like, that's only 17 days. Okay. There's no earnings between now and then. I mean, the market right now you're in the extreme. Okay. And you need to know that you're in the extreme. And by the way, maybe you don't have, okay, this trading application. That's fine. You go, well, I don't have that trading application. How can I figure this stuff out? Just add the call to the put. That's it. Okay. Just come up here and go like, add this little monkey. Okay. To this little monkey. Look, that says 118. That's 147. It's close enough. It's gauging the risk out there for you. Moving on over here, right? What are the opportunities for this? Understanding this, okay? And the first time you've gone through this, and again, if you're just brand new tonight and you've never been here before, okay, to TheoTrade, welcome. You just got thrown in the deep end of the pool. And I hope you appreciate that this is no holds barred stuff. Like, I am not showing you some red and green flashing arrow. I'm not showing you some I'm just not into Fibonacci's. I'm not a chart guy because I don't buy into, follow the bouncing ball. Let me tell you about volatility. Volatility, nobody knows nothing. Okay? They don't know nothing from day to day. Again, I had a pretty good idea that the Fed would come out in the next couple of days, but today, during the trading day, the Fed comes out. I mean, come on. Oh, you saw that one coming, right? Nobody saw that one coming. But you know how to actually gauge risk. You're going to be a lot better off for it. Let's actually explore, again, maybe Tesla, Facebook, Microsoft, Walmart, like even Walmart right now. Okay, even Walmart. Let's just quickly glance at Walmart because you think of Walmart as this docile animal. Okay, speaking of Walmart, apparently I've got a position on there. If you think of Walmart as like this docile animal, in the next 17 days, it has a $7 expectation of movement. Even Walmart's rocking right now, and that's what's crazy. Walmart has a 38% implied volatility, which is actually higher, okay, than the overall marketplace. And when I say Walmart's been rocking a little bit lately, this is about as deep into the chart as I'm going to get. Walmart yesterday moved from 107, okay, to 116. It's insane, okay? But that was its expected move. With that, okay, it's all great that you just saw this. It's great that you saw this. Now, time out for a second. What are you going to do with this? That's the thing. Expected move, okay? It sounds like a party, right? You can gauge risk. You can gauge risk. When I say gauge risk, I'm telling you, like, how to use it to gauge risk. In a moment, we're actually going to talk, and I like to do an example on a stock that everybody owns. And I could use, okay, Apple, or I'll use something like Microsoft. But let's just give you an example. Let's say Microsoft, let's say we're going to call it the EM, which stands for expected move. Let's say the expected move on Microsoft is plus or minus $10. Okay, plus or minus $10 on Microsoft. What does that mean? Well, let's actually put a time frame to this. Let's say that the $10 move is implied to happen in the next 2 weeks. Forget about a month. We'll just start 2 weeks. Okay? What can you use this for? That's what we're going to get into. Because everybody goes, that looks really cool. How do you use it? I'm going to show you precisely how to use this expected move. Initially, though, I'm going to show you how to use it, okay, as a risk mitigation tool. And that's like, I don't want that to be like a big scary concept when I say risk mitigation tool. All I'm saying is, we're actually going to use this to be able to control a degree of risk. And you're not going to look at the markets quite the same way after this, all right? Expected move in your risk. Now you recognize, okay, a little bit about risk and so forth. And, okay, what we're going to do, and I'm going to take you through just a really brief calculation. And again, I want to give you the Cliff Notes version of this. I want you to take the number of shares you're long or short and multiply this by the expected move and then double it. And you're like, what? Wait, what? Let me actually take you over, okay, to a trading application. So I'm going to take you to a trading application and we're going to pull up Microsoft. Okay, I just want to know who here owns Microsoft, either through a 401k, an IRA, okay, in any way, shape, or form. Who here owns a couple of shares of Microsoft in some way, shape, or form? It's actually why I'm picking this. And you know what? I would rather spend more time on a live trading application than I would giving you like a fictitious thing on a slide deck. So we are live now. And the reason I'd spend more time on here, okay, this is the nuts and bolts. You don't trade on a PowerPoint presentation. Okay. Nobody trades in a PowerPoint. I can't stand I'm stuck in PowerPoint land over here. Forget PowerPoints. Come to a live trading application. Let me show you how exactly this works. Okay. I don't care right now what stock you own. This is applicable to any underlying that people have actually heard of. Okay. I know somebody's like, I own a stock called Joe's Tree Cutting Service. All right. Any applicable underlying, something that actually trades. Here's the lesson, okay? We're going to take what we term the 30-day. This is 30-day. It's as close to 30 days as we can get. You're like, but it's 31 days. Relax, people. There's not always perfectly 30 days. As I said, this is live. This is the reality of trade. you get thrown, a situation, you need to deal with it. 30 days. I'm trying to gauge my risk in the next 30 days. The expected move, okay, is $19.44. So in this circumstance, okay, what I want to do, and again, I'm going to just highlight it here for a brief, okay, moment. What I want to do is I want to take the expected move. And again, we're going to call the expected move right here. The expected move, we're going to say equals plus or minus, and we're going to round it to 20 bucks. Now, what is that expected move saying? And I'm going to write this up a couple of different ways, right? What is that expected move saying? Well, here's what it's saying. This distribution curve. Here's a stock right now trading at what? Call it 65. I'm just rounding everything. It means we're supposed to move up 20 bucks or down 20 bucks. Now, I can come in here and go, okay, so that means the stock is going to move what? Well, $20 plus, so it's going to go to 185, right? Or it's going to go down, so it's about to go to 145. This is what we term the expected move. And I just scripted it for you perfectly on there from a $20 expected move. Everybody good? How many shares of this thing do you own? How many shares of this stock do you own? Let's say at this point, okay, you own, let's put it at 300 shares. Okay, with 300 shares. Now, what's your risk? I'm putting down my pen over here. What's your risk? What's your risk? I want to know exactly what your risk is in the next 30 days. What's your risk in the next 30 days with 300 shares? Okay. This is not self-explanatory. This is going to take a little bit of knowledge. Little bit of knowledge over here. Okay. Well, this is the point in time where I bring up the trusted calculator. Okay, and I know there's a lot going on the screen, but it's okay. We're just going to bring the trusted calculator over here. The first thing you do is you take 300 shares. Okay, so you own 300 shares and you multiply it by 20. Multiply it by 20. It's 6,000. So, okay, stop right there for a second. This is but assured. Okay, and you're like, what? Yeah, that number right there is all but assured. You're going to take heat. And you're going to take heat, okay, to a minimum tune of $6,000. But that's actually not the right answer. And I'm trying to lead you into this. Okay, what's the right answer? The right answer is this. The expected move is actually what we term a probability of expiring in a given range. Effectively, what I'm saying is Microsoft, that's almost the minimum kind of movement it's going to have, $20 higher or lower. Basically, what I'm saying is if you're going to do this, you will get $6,000 of P&L. Time out right there. Are you comfortable making or losing $6,000 in the next 30 days on this one position? You have to tell me, okay? I can't, this is where, this is what risk management is about. It's about playing go fish. Are you comfortable taking $6,000 of risk in the next 30 days just on Microsoft alone? Okay? Because what I'm going to tell you is going to blow you away. Take that expected move now. Take the expected move and double it. Where you're like, what? Take that expected move now and double it. Why should you double it? Because we're not looking for a probability of expiring. We're actually looking at what's called touching. I want the full Monty. I want to know exactly what my risk is going to be. Okay, full-fledged risk, you're looking at a $40 move. So, come back to your trusted calculator. You're actually going to get a $40 move. That is what we term, again, probability of touching. Probability of touching says $40 move times 300 shares. You're going to get $12,000 of P&L. Now, that's the part that blows everybody away. Okay, by the way, what I'm teaching you right now, all right, is a course. It's a portion of a course that was actually something I wrote for institutional TD Ameritrade. For a period of about 18 months, I worked and I actually built an entire institutional education division of TD Ameritrade. Institutional education, we taught registered investment advisors. Anybody that had more than $300 million under management learned this exact skill set. This is your P&L oscillation for this one position based on 300 shares. Okay, this is how we figure out, is 300 shares suitable for who? For you. Is 300 shares suitable for you? Because you're all but assured to have $12,000 of P&L swing. Okay, I am telling you right now, this is the stock. Because somebody just asked, this is stock or the options? I'm using the options to gauge stock price movement. That's what options are actually designed for. Okay, options are risk mitigation tools. Options give you feel, okay, a feel for how much the stock can move. In this case, the stock is going to have a full-on range, okay, of plus or minus $40 over the next 31 days. Okay, get with the program. That's absolutely huge. And I stress to you again and again and again, if you didn't fully grasp that example, okay, this is what defense is about. Okay, this is what defense is about. And I'll reiterate this. This monkey, yeah, knows how to manage volatility risk. You have to be able to look at your positions objectively. You have to know that if you go out and buy stock, and I know that you're going to go out, I know exactly what you're thinking right now. I'm going to wait for this marketplace to sell off a little bit more, and I'm going to go buy me some stock. Yeah? I bet you already did that, and I bet some of you already got stopped out. Okay? I know you went in. All right? Believe me, I've watched trades going through, and people go, how do you watch trades now? Everybody can watch trades. It's open season on watching trades. You can actually watch trades go through right here in the scanner. You can see what everybody else is doing. This is called a spread book. This is everybody else's trades. You don't know who the person are. It's totally anonymous, but I'm telling you right now, I can see people trying to bottom fish this marketplace. Without that skill set, okay, you ain't this monkey. This is the happy monkey. I don't think that's an iPad. I think it's a Surface. They would never give a monkey an iPad, okay, because it's far too easy to use. No, they gave him a Surface, so he can't figure it out. Anyway, you got to understand what I just taught you. Because, and I want to know, how many of you might be comfortable doing that moving forward? You just saw an example. There's almost 1,000 people on tonight. Okay, how many of you might be comfortable using some of that, of what I just gave you? Okay, because this is where people are like, why'd you double it? Well, that takes a little bit more time to explain. Okay, but all I want you to see is you can take the expected move, and you can immediately extrapolate that into how far the stock can move within a given period of time. And with that knowledge, I mean, come on. That's how you're going to be able to manage risk. Without that, you would never know that Microsoft has $12,000 of risk on just what? A couple of shares. And somebody was mentioning AMD. You look at AMD and you go 31 days out, and AMD, this is a $46 stock with a $9 expected move. It's huge, man. Huge. Do you realize on a percentage basis, 9 goes into what? You're like doing some math over here, like, yeah, okay. I mean, this is like a 20% move priced in. That's a 20% move priced in the next 30 days. But the full-fledged, what we call probability of touching, it's almost a 40% move in there. It's crazy. Just crazy high volatility. All right, we're going to move past this, okay? I'm going to leave that in the dust. All I want you is to understand at this point the concept of using the expected move, even if you didn't fully grasp it, but you can use the expected move to manage, okay, position sizing and manage risk. And I could show you 100 different ways to do it with that expected move. But this is the aspect that most people come here for tonight. You want to profit in the midst of extreme volatility. You want to profit in the midst of the extreme. And when I say you want to profit in the midst of the extreme, again, I need go no further, okay, than when I talk about like P&L. Again, $45,000 in margin, $8,000 in P&L today. Okay, that's big. The market, though, let's actually come over here and take a quick glance again. The S&Ps. The market, though, it's throwing off huge ranges. The bigger the range, the better the move. Okay, the bigger the range, the more opportunity. The better the move, the bigger the move, the more opportunity. You have to translate literally one into the other. And you can't sit here and worry about, are we going up? Are we going down? Okay. Did I get my head taken off in a 60-point move up in the S&Ps today? Absolutely not. Not only did we sit there and watch it, again, I executed a trade, all right? This move happened at 8 a.m. on the button my time. 6 minutes later, I executed into a trade, rode the marketplace down throughout the course of the entire trading session, all right? You want to profit in the midst of the extreme volatility? You have to become impervious to wild moves. You must make yourself impervious to wild moves in order to profit from them. If you do not understand that, okay, you can't survive volatility. When I say impervious, I put on a position today. I know what my risk was. I had $676 of risk. And again, I'm going to show you the trade once again because some people, if you arrived a little bit late, because I'm going to be talking about it here momentarily. I'm going to the spiders. I go to my monitor tab. I'm going to go to my account statement. I'm just going to go back literally one day. Okay, that's it. This is the trade from earlier today. All right, and I'll highlight it. Like literally, when I say it's the trade, okay, this is my trade history just in the spiders. I isolated to the spiders. I've gone one day back. I opened the position and closed the position. Okay, to open to close. My risk, $6.76. My profit, $15.10. Open the position 6 minutes after the Fed made an announcement. Close the position, 3 minutes before the bell went off. Why? Why not ride it off into the sunset? Okay, I knew what my risk was. And again, that seems pretty, straightforward. But you need to understand the logic and the strategy behind this. Okay, that's what we're going to get to. Bring on the offense. Once you understand and can control the risks that you have on, then and only then are you ready to go on the offense. And that's one of the things that, again, people don't get, like, this is offense and defense. That's what volatility becomes. And it's just as crazy as it sounds. That's why I put I formation. You got your fullback, you got your tailback, right? A little bit of a flanker over here. Come on, it's a wildcat formation. I'm just kidding. It's not. It's an I formation. I'm going on the offense, okay? The first trade that I'll use to go on the offense, this is one that I think tactically speaking, is pretty straightforward. I'm not going to spend all night explaining this, but this is an in-out spread. This is a trade, okay, that can be used in a marketplace for what we term bounce and fade. Okay, and I want you to remember that terminology when I say bounce and fade. Okay, you have a marketplace. Like let's call this. Let me just detail this for a second. Let's call this your marketplace. I don't care if this is the whole S&P. In a heavy volatility situation, what's this marketplace going to do over a period of the next month? What's this marketplace going to do over a period of a month? Let's say that we start here, and this is stock, and stock is trading, let's say, at $200. What's the stock going to do over the period of the next month? Anybody? All right. Well, right now, as of yesterday, it exploded back higher. It's sold back off. It's probably going to go a little bit lower, maybe rally back a little bit, head a little bit lower, rally back. I mean, this is like a stock chart, by the way, turned on its side. Like if you're actually curious, what is this stock going to do over a period of like the next month? I don't know. I think the right answer is, why don't we just go look at the S&Ps over the last couple of trading sessions? Just the last few trading sessions, what have we done? Down big, we bounced, we faded, maybe we bounce again, we come off. It's huge. All I ask with the in-out spread, all I ask in this particular strategy is that we have bounce and fade. Okay, what's a bounce? The bounce is the up move. What's the fade? It's the move back down. Bounce and fade. And that we actually oscillate through prices again and again. In this case, it's the spiders, it's 300. Okay, but let's make this applicable to like Apple. Okay, why not? Why not do a trade in Apple? What do you guys think? Apple's going to go higher or lower? Is Apple going to go higher or lower? Absolutely. Okay. Well, I've got an options strategy. And in this particular options strategy, right, I can go out there and I can actually isolate myself, okay, and limit my risk, for example, to $1. I'm going to limit my risk to exactly $1. Now, listen to me very carefully to be able to make exactly $1. Why would I ever want to do that? I want to explain this. I want to back you guys into this a little bit. I want to limit my risk to exactly $1 to be able to make $1. Would you want to do that trade? Okay. Anybody? Come on. Let's go. These are not rhetorical questions. So I want to risk $1 to be able to make $1. Now, somebody says, why on earth would you ever want to do that? First of all, okay, I am literally saying that I'm going to put on a strategy, and in this strategy, I'm literally going to risk 1, okay, to make 1. Risk 1 to be able to make 1. And I'm going to show you exactly why, without even going into too much detail. The stock is trading right here, and the stock is trading at 200. Now, this is going to be an option strategy. The stock, okay, let's say that this first trade I'm going to do is bullish. I'm going to do a bullish trade. You put the trade on, the thing goes massively against you. Massively against you. The stock is no longer trading at 200. Now the stock is at 190. It sold off by $10. In fact, the next day, stock goes all the way down to 185. Are you dead? Are you dead? Okay? Because it's more important right now for me to explain the logic of this trade than it is the trade itself. Meaning that the trade itself is a means to an end. Like executing the trade, anybody can learn that. But you have to learn, okay, to limit that risk to the downside. Limiting the risk to the downside in this case is going to be defined to precisely $1 to be able to make $1. But here's the difference. With options, they're going to make sure that you absolutely can't lose more than $1. So if we go down to 185, you're like, oh man, I lost my $1. How long is this trade good for? It's good for 1 month of time. It's 1 month. What can happen in the next month? This just happened in 3 days. What happens in the next month? We rally back. All of a sudden, boom, we're all the way back up here at 205. At 205, you're fully profitable. You take the $1 off the table. You make $1. You book the trade. You're out. That's what an in-out spread is about. Okay? And again, if you lost your $1, you're alive. It's a beautiful world. You're alive. Okay? The opposing is also true. You could put this trade on bearish. Okay? If you wanted to risk $1 to be able to make $1, risk $1 to be able to make $1, you wanted to be bearish. Same stock. It's a $200 stock. You put the trade on, and all of a sudden the market rallies all the way up here to 210. You're like, oh, I'm dead. I'm dead. This $1 is not fully lost, okay, until, for example, your 1 month of time is running out. But if you don't think 1 month is enough, why don't you put this trade on for 2 months? Why don't you put this trade on for 3 months? Why don't you put this trade on for 4 months? You could do any of that to risk your $1. And by the way, does more time in options cost you more money? Does it cost you more money in options? If you put a trade on for more time, does it cost you more money? I know some people are brand new to options. They've never traded an option. Who here tonight has never traded an option before? Because there's so many misconceptions about options. If you've never traded an option before, I want to know. Okay? If you say me, I've never traded an option. Fantastic. Okay? Because people are always worried about time value. They're worried about this. They're worried about that. Okay? Most people think that options further out you go in time is going to cost you more money. It's not. Let me actually back you into this now. Now you tell me a stock. You tell me a stock and I'm going to show you an option trade for it. Okay? Give me a stock of your choosing. Would you like to start at an Apple? Okay? By the way, I want the stock and then I want you to tell me if you're bullish or bearish. You tell me if you're bullish or bearish. Okay? Somebody said gold, Nvidia short. You know what? That's the first one I'm going to do. I'm going to do Nvidia. You know why I'm going to do Nvidia? Okay? Because Nvidia, that thing will scare the bejesus out of you. Look at Nvidia. It was a $316 behemoth. Okay? Fell all the way to 240, rallied back up. Now, okay? This Nvidia trade was actually from a gentleman by the name of Igor. I love it. Let's do Nvidia. And you want a short position. Well, I could open up the trade. And by the way, I'm just looking out here. There's no earnings, nothing to worry about in the future. I could do long or short. But in this case, okay, I could build a short position. What do you want to do? You want to do 17 days out? Want to give yourself 31 days? Ooh, I don't know. Okay, let's do this. Let's do this. Okay, first of all, there it is. This is a 250 wide spread. Now, this one's going to cost you $1.18. Now, people go, that's not risk $1 to make $1. Yes, it is. Yes, it is a risk $1 to be able to make $1. Don't you think I'm not looking at this? Okay, why? Because this is a 250 wide spread. So in this case, I could be risking $1.25 to make $1.25. That's a trade. It's 31 days out. If I want to be bearish, I could do that trade. But wait, why do it? Why do it for 31 days out? Okay, why not go further out in time? I could go further out in time. Could I go 37 days out? If I did the same trade 37 days out, would it cost me more? In this case, if I did the same trade 37 days out, okay, but offer spread's a little wide, it'll actually cost me less. I can go even further out in time. I could go 73 days out. Now, 73 days out, I have to do a $5 wide spread. That stuff gets a little confusing. This is a $5 wide spread. And somebody goes, that's not risk $1 to make $1. Yes, it is. Look, okay, that's $2.50 to make what? It's $5 wide spreads. The most you can make is $2.50. You're risking 250 to be able to make 250. All you got to do is hold the thing. Maybe the stock bounces. Maybe the stock goes down. This is a bearish trade. Let's do another one. Okay? Give me another one. Somebody actually said Tesla. Okay, Tesla, the most feared animal on the entire street, right? In terms of Tesla, what do you want to do? You want to go 17 days, 24 days? Let's do 10 days. Oh, did you want to be bullish? Did you want to be bearish? Come on. What'd you want to be in Tesla? Anybody want to be bullish? Does anybody want to be bullish in anything? Okay? Let's be bearish again. Somebody was like, I feel the urge to be bearish. Okay? Here, Tesla, $5 widespread, $1.23. Okay? You want to go further out in time? Let's go 37 days out. All right? Here's a $10 widespread. That's a big monkey for about $5. It doesn't cost more the more time you have. You can go into Amazon. Okay? Can you think of anything bigger and uglier than Amazon? All right? Other than Jeff Bezos himself. Okay? But look at this. It's a $2,000 product. And people go out there and they're like, I'm scared. Hold me. Listen, all you have to do is use one of these spreads. By the way, it's funny because everybody right now is like, hey, man, can you do bearish trades? Okay. Can I do a 1-day trade? I could do a 3-day trade. All right. I could do a 3-day trade. And look how listen, that's real. Okay. When I say that's real, that's the pricing in here. So just be aware. These are how you define your risk. In-out spreads. And yes, they're option spreads. And yes, do not let that stuff intimidate you. Okay? Here are some real spreads that I've put on recently. And I'm going to show you some live trades in here too. Okay? This is Lulu. Now, on the trades, these are live trades. Okay? I call them examples, but they were all live trades. In fact, in Lululemon, I entered this on February 3rd, exited February 27th. I bought a spread for $2.35 debit. I closed it for a $3.70 credit. Every $235 I invested, I got back $370. It's a 57% return. Next, by the way, I can go all night. The QQQ, that's the NASDAQ. This is actually what we term an ETF. I opened the trade February 6th. I closed the trade February 24th. I opened the trade for $80 invested. I got back $139, 74% return. Time out for just a second there. Okay. You need to also realize just because I'm saying $80 doesn't mean I need to be $80. This could easily be $800 to return, okay, $1,390. It's a 74% return. Remember, did I know the marketplace was bearish? Did I know the marketplace was bearish on February 6th? No. Did you know the marketplace was bearish on February 6th? No. Is that okay? Yeah. Why? Because I was just waiting for a move. A move. I didn't necessarily know the move was going to come. I was just waiting for a move. Okay. Next trade, JP Morgan. All right. I can go again all night. JP Morgan. Here's one that I put on February 6th. Exited February 25th. Every $81 I invested, I got back $159. It's a 96% return. This one's an absolute home run. Did I know a big move was coming in JP Morgan? No. Did I really care? I don't really care. You know why I didn't really care? I have $81. Or in this case, I had $810. I had $810 in it. Okay. I think I could probably live with myself in the morning if I took that kind of a hit. Want to go further? I want to go further because we'll go further. Okay. Here's one. EEM. This is the Emerging Markets ETF. Right? EEM in-out spread. Open February 10th, closed February 24th. Every $90 I invested, I got back $156, 73% return. Remember, $90 could be $900. It could be $9,000. To return $15,000, okay, $600. That's a zero. Just keep adding zeros. You want to do the trade bigger? Do it bigger. It's a 73% return. Okay. Now, I could show you time and again all the different strategies that I have on. And I tell you what, somebody actually mentioned American Airlines. Let me tell you, American Airlines, how chaotic is that? Oh, it's crashing and burning. You want to do a bullish trade on it? Do a bullish trade. Who am I to stop you? But what you have to know, which expiration? I wanted you to see that I actually have trades on American Airlines. Think I didn't think of that one first? Of course! I got trades on American Airlines. Okay? I've got trades in energy sectors. Look at all the trades I've got going in the oil and gas. Right? Position, 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 position. Look at the trades I've got going. Again, energy sector, position, position, position. Right? Believe me, this monkey is going after those trades. You know how I'm going after him? I'm going after him with in-out spreads. And so be it. There's times when I'm going to take a hit on an in-out spread. And there's times like right now, I just showed you an emerging market trade. Okay, the emerging markets, look at this. This is a bullish trade I have on right now in the emerging markets. As I said, I could go all night. This was a bearish trade in the EEM. Now I have a bullish trade in the EEM. When I say I can go all night, you know how many trades? Okay, this is volatility, people. You don't even have to be good in volatility. You just have to know what to put on, okay, and how to structure it. When I say you don't have to be good, do you think I thought a lot about direction? The market is going down. Sooner or later, it's going to go up. Okay, I'm just waiting for a bounce in the EEM. Ironically, today the EEM bounced a little bit. I'm up a decent amount in the EEM. And I'm telling you right now, people, this is why you want to use in-out spreads. Okay? You're not going to get stopped out. There's no getting stopped out. Did I not mention that? Are you going to get stopped out? No. Look at your risk in here. It's 90 cents. If the trade goes against you, what are you going to lose? What are you going to lose? You're going to lose 90 cents. Okay? Now somebody was asking, like, can I trade single options? No way. You buy a call in this marketplace, you are dead. If you buy a put in this marketplace, you're going to get killed. You can't hold, okay, regular positions overnight in volatility. Maybe intraday, but you can't hold positions overnight. You have to use spreads. In-out spreads defines your risk, limits capital exposure. You never need to buy or sell the stock. Again, there's no probability of being stopped out, okay, and provides a high probability of success because you can initially be wrong in terms of price movement and still come out ahead. And I'm going to remind you of that. I'm going to bring it back up. Again, I like to talk a lot about it on a live trading application. Do you think I was wrong in the EEM? In the EEM, I got bullish. We popped up here and we popped up again. Okay, I got a little bit of a bullish position on here. Even if we tank in the EEM, still got a chance that we come back sometime in the next 30 days. Okay, lo and behold, that's why I got a position on. This one's 17 days. But look, there's another one 45 days out. Okay, what am I actually doing in here? The right things. Okay, the right things. You need this strategy in your life. You need this in your life because this is how you cope with the insanity of volatility. I'm far from done. In terms of one strategy, forget it. One strategy doesn't fit all. Now, what our members are saying, use this strategy to double the small account. Like Dylan T, who wrote in to say, the in-out spreads have been very helpful as I've been able to get on a hot streak and double my small account in 4 months via the use of these in-out spreads. Learn to minimize your risk by limiting your account's exposure. Okay? In the marketplace, like Phil S, who wrote in to say, using the in-out strategy last week, I locked in $1,275 in some HAL put spreads. HAL is Halliburton. And today, I locked in profits of $1,240 in several positions I identified. Been averaging 7% a month for the last 4.5 months, profits of over $11,000, and never had more than 25% of my account at risk, usually much less. You guys ready to continue on? Okay? Because let's go. Let's go! Because then somebody just said, how do you hedge? This is a hedging strategy. This is what we call a VIX volatility spread. I'm not going to go into too much depth. Okay? All I'm going to tell you about the VIX volatility spread is a very simple idea. Listen, the VIX. What is the VIX? The VIX is the beast. It's the fear index. And the VIX right now is probably at 38. There's all kinds of trades you could do on the VIX. But one of the greatest trades, okay, on the VIX, one of the greatest trades is we know when the VIX is very, very low, sooner or later, the VIX will climb. And when the VIX is very, very what? High, like it is right now, sooner or later, it collapses back down. That's all you have to know. All you have to know in this particular case, okay, volatility is low. If volatility is low, sooner or later, by the way, that may take forever, right? When it's low, can volatility stay low for a year? Can volatility stay low for 2 years? Yep. Well, if volatility is low and sooner or later becomes higher, I need a strategy that can stand the test of time because eventually volatility goes up. Do you hear me? Making sure everybody's on the same page, okay? Consequently, right now volatility is high and sooner or later high volatility will contract back down. I need a strategy that when volatility is high and sooner or later contracts back down, I want to be part of it. Enter the VIX volatility spread. Okay. What is a VIX volatility spread? Well, let me show you. All right. The VIX volatility spread. This is exactly what it looks like. Now, the VIX vol spread that you are looking at was for low volatility looking for high volatility. Low volatility looking for high volatility. And I said to you, I said to you a moment ago, how can you have a strategy that just, like, you don't know when volatility is going to go up? Everybody agree with that? Somebody said just a second ago, they said in 2017, volatility stayed low for the entire year. You're exactly right. How about this? We're actually going to sell options, to finance the purchase of options. That way, our cost up front is negligible. The cost up front is negligible. The risk is very minimal. Very minimal. The returns can be explosive. In this particular strategy, and this is a little convoluted, but when you're scared of volatility and you own a bunch of stock, this strategy is a hedge. A hedge is designed to limit your risk, limit some of your exposure. In this hedge, I didn't pay anything for the hedge up front. It's called an even money trade. And this trade, was opened. I want you to see it was opened in January. Did I know volatility was coming in January? No. But I always have a VIX vol spread on when volatility is low. And sooner or later, low volatility becomes high volatility. People, time out. If you know anything at all about TheoTrade or anything at all about me specifically, I, am a volatility crisis seeking, trade geek. This is what I live for. Strategize. Paid nothing up front for it. I could have done this month after month after month after month. I didn't do it month after month. I do it quarter after quarter after quarter because doing it month after month is ridiculous. I put it on in January, put the trade on in January for March because I'm lazy. I don't want to sit there all the time and I got to manage it. You get lazy with it. Fine, get lazy with it. Put the VIX trade on for all the way for March. I didn't know that February was going to be explosive. February got explosive. I exited the trade for a $3.75 credit. If you did 10 contracts of this, it's $3,750. And again, this trade has very minimal risk. Very minimal risk, right? Onward and upward. This is actually an email that came in, and this is a client that I wanted to read it. It was on February 27th because I think a lot of people probably got beaten up last week. And this is an email that came in last week. I could show you 20 emails that came in today. In fact, I could even scroll back into I'll show you here in a moment. I'll just jump right into it here a little bit later. When I say scroll back, I can show you live comments that were going on all day because our traders, didn't just live to tell the tale. Our traders are absolutely knocking it, out of the park. It's, again, we've had home run after home run, and that's important, to me, and should be important to you. All right. With that, it says, Dear Don, thank you for your service. Always on time, and you and the staff answering my emails so promptly, so appreciated. I struggled the last months. A little bit new. Placed the trades you suggested and tried some of my own. Account size, not so great. So I had to work carefully. Had to take off some RTS and VIX trades, and could not so much. But this last week, I tried to keep near you. Basically, was trying to do the same trades. Handsomely, I made some good profits. And thanks for your guidance to help me take the profits in the midst of these volatile markets. I just felt great in belonging to your TheoTrade with such an excellent help and guidance. It's just amazing. Thankful, AC. And AC is actually from South Africa, well, Uruguay by way of South Africa. So figured I'd just share that with you guys. Onward and upward. This is why I want to use VIX volatility spreads. VIX volatility spreads cost nothing up front. They define your risk, provides direct exposure to movement and volatility. That's key. Provides direct exposure to movement and volatility. Provides a high probability of success. You can initially be wrong, again, in terms of price movement and still come out ahead. Volatility could be low for quarters, for months, for years. Doesn't make a difference. Just doesn't make a difference. Volatility could be low. When volatility eventually, erupts, it erupts. And now, where's volatility? I'll finish this VIX volatility, section. I've got one more strategy to show you here, but I'll show you this VIX volatility. Okay, sooner or later, this extraordinarily high volatility. I just want to show you how this works over the last 5 years. Okay, this comes up, it comes down, it comes up, comes down, comes up, comes down, spikes, spikes, spikes. It'll come down. It'll come down. Maybe not today, maybe not tomorrow, but it'll come down. And when it comes down, we have a strategy for that as well. All right. Again, you need this stuff in your life because you have to be able to deal with this kind of volatility. Onward and upward from here. Next, the risk twist spread. The risk twist spread is, if you would, this is the pinnacle of all volatility-based trades. And for those of you, if you've never heard of it called risk twist, there's actually another term that we use here at TheoTrade. This happens to be part of what we term the infinity spread. Okay? Infinity, I can't write with this pen. Infinity spread. So this is actually the Grand Slam home run, spread. What we'll do in this case with the infinity spread, I'll explain it as if we are in the spiders. Let's say here we are in the spiders. In the spiders, we're trading at 340. What a risk twist does is a risk twist, okay, puts a very, very small position way away from where the underlying is. And if the marketplace tumbles that very small position, and that position, the cost is next to nothing. But if we come down hard and fast, this little position absolutely erupts in terms of price. Okay? Structure of the trade is everything. We don't just go out there and, put a little of this, put a little of that. The risk to a spread, okay, it just erupts in P&L when the marketplace comes down. This is what it looks like, okay? This is a risk twist. These were live trades, okay? All of these trades were placed. I still have a number of them still on. This was one, again, I put it on in December. Did I know that the marketplace was going to get crazy? Of course not. The trade only cost 36 cents. That's it. This is in the XLF. What is the XLF? For those of you that don't know, it's the financial sector. Now, I want you to look at the trade because I don't want you to get thinking like, oh, I'm going to have to watch all this. I'm going to have to learn this and learn this. This is a trade. We put it out to you, meaning that we put this trade out to everybody. All the risk twist spreads that I do, we actually blast a text message. I'm putting on a risk twist spread. Why do we do that? Because you only have to do it quarterly. And I put it on for the March expiration. I exited the trade. Why did I exit the trade? Because it made a big profit. Every $36 I invested, I got back $135. Now this one's only a 275% return. I say only. Okay, that is meager for a risk twist. But I wanted to show you, you could have a $2,000 account, $36. Who cares? $36. Put it on, make $135. Or this could be $360 to make what? $1,350. Or it could be $3,600 to be able to make what? $13,500. Okay, I wanted to show you the most basic form. That was one. It was on. We're out of it. Next, the spiders. Okay, the spiders. This is a big one. Now the spider trade. Again, the spider trade. When I say this is a big one, yeah, the spider trade is. This was the beast. The beast. This one is actually a 485% return. Every $180 I invested, I got back. Okay, and that's literally $180 I invested. I got back $1,053. Okay, as I said, I gave you the example inside of the spiders. Now, if that's not enough for you, okay, have I done any other of these trades? Yes, I actually did one inside of the XHB. The XHB, which was an absolutely wicked move. Let me show you. Again, I prefer rather than detail, and I've got a bunch of different trades I'm doing in the XHB. These are trades that I literally put on today. But rather than just detail, okay, what you think, what you know, let's actually go back. We can go back 30 days. We can go back 40 days. We can go back into the XLU. We can go to the XHB. Again, huge returns in here. All right. And you're like, wait, what? Okay. I'm showing you right now some of the returns. Here, I paid 56 cents for this and 53 cents. I actually did two different, okay, it's the same trade at different times. So I put on more and more contracts. That's 50 cents turned into $3.60. That's 50 cents turned into $3.45. Again, we're looking at 4, 5, and 600% returns. And again, in this one, I just wanted to show you my account. I put some of this on Valentine's Day. I put a little bit more on, okay, here on the 21st of February. Closed that out a week later. We're talking 5, 600% returns. This is the grand slam of strategies. It's the risk twist, okay? And I'm telling you, just because, you're like, oh, the volatility is already here. That doesn't make a difference. We think these opportunities are not going to be here again. This is why you want the risk twist spreads. Increase in value when exposed to heavy volatility. Increase value when the markets sell off. But you can also trade these things for a huge rally. I just told you a second ago, okay? I'm just showing you one half of the trade. We can actually create this into an infinity spread. So when the marketplace explodes back to the upside, we'll have profitability there. Significant profit potential and a downside move. Loses minimal capital if the markets continue to drift. Need only be placed a few times a year. It's the perfect spread to reduce risk of a stock portfolio, long or short. And it's an excellent tool if you're looking for just grand slam, home run, big market event trades. And again, as I say, with these 3 strategies, you need each of these in your life, okay? I mean, what it comes down to, the aforementioned trades, all right, what they're designed to do is give you the power to trade massive stocks and index products. I mean, massive stuff. You could trade Amazon. You could trade the S&Ps, okay? You could trade Tesla with mere pennies at risk, okay? And I don't want you to be afraid of time, because I specifically showed you trades this evening that are not about sitting in front of your computer. I showed you an in-out spread. Put it on, walk away. We'll even text out a trade to you. I showed you a VIX volatility spread, only put on quarterly. I showed you a risk twist spread, only put on quarterly. Okay, this is as hands-off as it gets. It's great for part-timers. And you can actually use what we term good till canceled orders. They call it set and forget order types. You got a fraction of your time. Even a fraction of time, it's enough to see some results. It's a part-time thing. Listen, characteristics. These are all what I term volatility spreads, the collective. These volatility spreads, the attributes of them are undeniable. Okay, you don't have to buy the stock. You define your risk. Risk is limited precisely your comfort level. You don't have to use a stop order in any of this. I can't stand, stop order is going to be the death of you in this business. It'll be the death of you. As soon as it gets volatile, you can't use a stop order, right? It's the perfect spread to reduce risk of stock portfolios, and it's an excellent tool if you're seeking returns to build a smaller account, right? Listen, with the strategies as you showed too, you can have a $2,000 account, you're fine. You could do this in an IRA, you're fine. All of the trades that I'm showing you tonight were done in retirement accounts. What I've been showing you all night is my retirement account. But you need to learn to build these things. And I don't want to let options intimidate you. I asked that question earlier tonight. I said, how many people here have never, ever traded an option? You know what? I know that not everybody answers the questions that I ask in here. That's okay. Okay. But if you've never traded an option, it's important that you not be intimidated by this. Okay. That you realize that the spread below, this is a risk twist spread, that this spread right down here, it's $1.80 a debit. Okay. That's okay. And that this spread though, it's a massive power saw. Use it correctly. Incredibly effective in creating returns. Use it incorrectly, you're going to cut off a couple of fingers. It is a power saw. Okay, we can teach you how to use this thing efficiently, correctly, and I've got to know, right? You can trade these volatility spreads. You might not know anything about options. You have limited experience in options. Don't let this stuff intimidate you. The strategies that you're looking at, you're going to need them for the foreseeable future. And I don't say that, to be condescending in any way. I don't say that to be, fearful in any way. I'm saying it because the bottom line, what we're in right now is not going away. Volatility, we cracked it open. The Fed came out and what? The Fed just told you we are in serious crap, right? And sorry to be so literal by using the word crap, but we are in it right now. When they cut by 50 basis points, in an emergency situation. Do you know that the last time that we had an emergency cut, okay, started in January of 2008? There was another emergency cut in September of 2008. Do you think they cut for an emergency because things are good? Okay, that's why the markets tanked today after they cut. And you need to understand that these strategies, it's the only thing stopping you, okay, from what? The abyss in this marketplace. You got to learn it. We can show you how and how, like literally when to place volatility spreads. And it doesn't matter. People right now are like, but the volatility is high. Good, because when the volatility is high, it provides the exact same opportunities as when the volatility is low. But the separating factor here, what you really need to know, we at TheoTrade, we create detailed trading recipes for every strategy, including what? These volatility spreads. We had a VIX volatility spread. We had an in-out spread. We had a risk twist spread. Okay? Listen, you would not bake a cake without a recipe. Why do you trade without one? That's what we really do here. Okay? Because this is what you need to know to successfully enter and exit these volatility spreads. All right? First, you got to know, I don't know, what makes a viable volatility spread candidate. When I'm talking about volatility spreads, like we were just looking at an option chain a moment ago. I pulled up XHB. Most people don't even know what XHB is. It's the home builders. You see all the trades I have in the home builders? Great. Okay. Go take a look at this, utilities. See all the trades I have in utilities? Great. You now know that these are candidates. Why am I trading them? Okay. Why am I trading these? Why are these good candidates? What volatility should I seek out? Should volatility be high? Should volatility be low? If volatility is low, what strategy do I use? If volatility is high, how do I take advantage of high volatility right now? What options expiration do I select? By the way, did I not show you that a moment ago? What options expiration? Go pull up the spiders. Just bear with me here for a second. Pull up the spiders. There's a 1 day, a 3 day, a 6 day, an 8 day, a 10 day, 13 day, 15 day, set hike, 17 day, 20 day, 22 day. It's insane. Look at this. I have something on 73 days out. Oh, I can't even see what it is. My, oh my. 73 days out. You better know exactly what options expiration to select. Okay? What should be the delta of the option I buy? A moment ago I showed you a risk twist spread, and a risk twist spread was a buy, it was a sell, it was a buy. Okay? What do I buy? What do I sell? What options do I sell against my position? How do I actually build the trade? Like when I say how do you build the trade, how do you literally go in here and say, I want to build a risk twist spread? Because there ain't no risk twist spread in here. There's no infinity spread in here. I want to go deep and wide, 4-month, unbalanced vertical roll. I want to go 4-month, 4-strike, double diagonal, straddle, strangle swap. I want a double whopper with cheese. Who cares? It's garbage. We'll show you exactly how to do that. Okay? What's the right amount of risk for me? Let me show you exactly what we do here at TheoTrade. We create recipes in trading. That's what this really comes down to. You're like, anybody, tonight, I showed you a lot. I showed you what a risk twist spread is. I showed you about an in-out spread. Anybody can learn strategy. Anybody can learn strategy. But what trading comes down to, it's not strategy, it's recipe. It's about answering the what ifs. You need to know what might be a good stock ETF candidate for volatility spreads. You got to know what stock or ETF to use to make these trades work. You have to know what the correct options expiration cycle to buy or sell the volatility spread in. You have to know how much capital do I commit. If you have a $2,000 account, a $2 million account. Listen, I have worked with everybody from $2,000, okay, up to 10 billion. Literally 10 billion. Again, I built and ran institutional TD Ameritrade education for a period of 18 months. I was bored out of my mind after 18 months of dealing with people that had way too much money under management and understood nothing. Okay? And what we taught them was exactly what we're doing here. Going through the what ifs. How much capital do you commit to these volatility spreads? What strike price options do you buy and sell, and how many? In growing a small account, what should my allocation be? We have the answers. That's what we do here. We build recipes, definitive criteria. We build checklists for each strategy, and each unique variable. When I say variable, what do I mean? What if the stock goes up? What if the stock goes down? What if expiration is coming? What if there's a dividend payable? Okay, oh my. What if there's earnings coming out? Every single detail that you're going to encounter is covered in these checklists. This is pre-flight. So we take you through a pre-flight, just like a pilot would do when they get into a cockpit. They don't just turn the key and hit the gas and fly off, right? They walk around the plane. They're pulling on the engines. Okay, it's great when you're in O'Hare and it's minus 10 degrees out and the pilot's walking around the outside of the plane freezing. Okay, but they're going through a checklist. They have to go through it. But then once they actually are done with the checklist, then they get in the cockpit and guess what? They have a checklist in there. And then when they're done with that checklist, okay, while flying, something goes a little bit awry. What do? Refer to the checklist. They know. Okay, step A, step B. If this happens, what do I do? All the different variables are covered in there. That's what we do here. We have the answer to the questions. We'll give you the right probabilities for the trade. How many contracts do I trade for the account size? We'll give you when do I close the volatility spreads. What if we sell off big? What's the correct return for the strategy? If we rally massively, can you fix a losing trade? It's about how. It's about when. It's about why. It's about what price. And it's just the beginning, though, of the variables that you're going to face when trading these volatility spreads. It's literally the beginning. And I know that everybody thinks to themselves, hey, I'm going to read what a spread is. You can Google right now. You can Google what a in-out spread is. You can Google what a risk twist spread is. You can Google what a VIX volatility spread is. Maybe even know how to build a few spreads. But that's not what this is about. This is about criteria. This is about a recipe. Okay, and that recipe comes from 20 years of trading experience myself. But it also comes from access to client order flow for 15 years. Okay, knowing that I viewed and studied literally millions of trading accounts. I ran education for over 15 years at a firm with the largest options order flow in the entire industry. Nobody had a bigger retail options order flow, okay, than Thinkorswim, and then it was TD Ameritrade. No one saw more option trades go through, okay, than myself and the associates. Criteria is your recipe for success. On these strategies, what you do is you follow the strategy and the corresponding criteria because it requires the utmost attention to detail, and we literally spent years fine-tuning these trade setups and these pieces of criteria. And when you approach a section on criteria, you follow the steps to build a trade. I am doing a class this Saturday live. It's March 7th. It couldn't wait. We need to get it out. It's Guide to Surviving and Thriving in Extreme Volatility. Okay. This class is going, to incorporate, and I'm going to go through the details here momentarily. This class is going to incorporate a tremendous spectrum of different trades. It is designed for the absolute novice to the most extreme trader because it's going through a skill set that all of us need. And it literally how to deal, with some of the extremes that we're currently in. As I said, it can't wait. We are doing the class live, March 7th. The class is recorded. Everybody asked that. By the way, when I say it's live, it's March 7th. It's 9 a.m., to 12 p.m. It's going to be a 3-hour course. I'm probably going to run over a little bit. The class slide deck that has all of the entry and exit criteria, the checklist, is available the morning of March 7th. That's this Saturday. If you can't make it live, we archive the course immediately, and we provide you 24/7 access, or download capability on our mobile application. You can watch this on iOS or Android. So if you have an Apple phone, Android, it also works, of course, in your iPads, any of your tablets out there. The class is $497. I'm going to go through the curriculum here in a moment, but I'm also going to explain one aspect. Tonight only, we're going to give you a couple of bonuses with it. So bear with me for a moment because I think that you guys are really going to appreciate not only the bonuses, but really some of the curriculum. This is the curriculum for the course this Saturday, Guide to Surviving and Thriving Extreme Volatility. We're actually going to learn initially in the course defensive structuring. Defensive structuring, even the most extreme markets, they're not going to keep you awake at night. We're going to discover how you can actually aggregate all of your market risk and know precisely how much you're making or losing before the market move. Basically, what we're going to do is we're going to play the game of chess, and we're going to play it 5 steps into the future. No matter what you have on, I don't care if you have a 401k, that's what we're going to talk about. You have an IRA, that's what we're going to talk about. If you have no positions on, fantastic, because you know what? You are going to have positions on sooner or later. You have to know what your risk is before the market makes the move. You're going to understand volatility like never before. More importantly, how to harness it. Position sizing. You better learn position sizing because higher volatility, allocations change. Allocation is critical for success in higher volatility. Then, after we talk about the defense, we're going to go on the offense. We're going to go offensive. We're actually going to talk about volatility steps. okay, these spreads with detailed step-by-step. We're going to build your volatility spreads. We're going to learn to use certain order types so they don't have to be glued to the computer, even in volatility. Quite ironically, sometimes you need to walk away from the computer. Sometimes you need to walk away from your computer, because if you watch the extreme, you're going to get enveloped in it. These volatility spreads can be done with an account as little as $2,000, okay? And the trades can be done in retirement accounts, minimal options experience, smaller accounts looking for large upside. Most important point that I like to make, follow the recipe to build the trade. Again, follow the recipe to build the trade. All right. Now, these are the bonuses tonight, okay? And I'm telling you, you're going to want to listen to this because when we talk about TheoTrade, listen, I have been in this industry now since the late 90s. And I started building an education company for Thinkorswim all the way back in 2001. That's when I first started I'm like, hey, I'm going to build you guys the education company and we'll go that way. And I did, okay? But over those 20 years, when I say I've seen everything, I've seen everything. And what annoys me about most of these education companies, most all of them, first of all, the people that teach, they don't know what they're doing. I mean, there's somebody that I was a teacher turned professional trader. I was a taxi cab driver turned professional trader. Okay. I used to be a monkey at the zoo and now I'm a professional trader. Okay. Me, I grew up around trades. Then I spent 15 years, okay, running one of the largest brokerage firms on the street. More importantly, I actually ran the education side of it. Not only have I actually traded everything and seen pretty much everything, but we've actually built and structured, okay, what kept TD Ameritrade clientele educated for a very significant period of time. And what more or less I'm getting to over here, I don't like when somebody goes out there and you have a class here, an indicator here, and then they charge you $1,000 here and $1,000 there. Listen, we get it here at TheoTrade. You want everything to trade and invest, and you want to do it at one place and one price. First bonus we're going to give tonight, we're going to give you access to everything that we do. I think that made it pretty simple. When I say everything we do, we're going to give you 88 trading classes to begin with. We're going to give you access to every trading class that we've ever done here at TheoTrade since the day we started. It's 88 classes. Here's just a little smattering. Okay. By the way, this is a bonus on top of the March 7th. Why do we do this? Because I don't think it's fair when somebody goes out there, they go, yeah, you took a class and you paid $1,000 for it. Now you got to come back because you got to buy yourself an indicator and go to the next class. And by the way, you need to pay $24,000 to get that indicator. It's just ridiculous. We're going to give you access to 88 trading classes, guide to surviving and thriving in extreme volatility. I'm going to tell you right now, I don't care where you go, what education you think you've done, bar none, you ain't seen nothing like this. Okay, nothing like this. 88 classes, and I'm not the only instructor. Here's a couple of the classes. There's an in-out spreads class, okay? A black book spreads class, how to collect income being short. The next big short, that's actually a risk twist spreads class. Guide to selling high probability spreads. Iron condor class, selling premium and minimizing your risk. Survive and thrive in extreme volatility, okay? Day trading NASDAQ futures, covered calls, essential skills for consistency in trading. Top 10 skills for growing a small account. Pairs trading. It's just a smattering of the courses. It's easily over $9,000 in courses alone. Okay, we just give you access to every course that we've done. Now, I left TD Ameritrade in 2015. We launched TheoTrade in 2016. In 4 years, we've done 88 trading classes. You know why we've done so many? Because we do at least one a month. There was actually a period of time where just do another class. Because we have, 7 full-time instructors. Allow me to introduce the TheoTrade Clue, Jeff Bierman. If you've ever been on the Thinkorswim charts, you owe a great thanks to Jeff Bierman. Jeff Bierman is also known as the professor here at TheoTrade. He moonlights with us. He's a professor of finance at Loyola in Chicago. Okay, and when I say he moonlights with us, he's a professor of finance over there. He was also the former chief market technician for TD Ameritrade, and he's responsible for over half the studies on the Thinkorswim charts. Next in line, Matt Williamson, our market neutral option premium selling strategist. We actually found Matt. Okay, well, I found him through the risk department at TD Ameritrade. I'll build him up for a minute over here because he'll appreciate this. I wanted somebody, okay, that traded and sold a lot of premium. So what I did is I called one of my buddies who runs risk over at TD Ameritrade. He said, nobody's bigger than this guy, Matt Williamson. It's just a guy that trades. And I'm like, okay, done. Called him, and Matt's like, yeah, I'll do it. Okay. It's one of our instructors, Corey Rosenblum. Known Corey for almost 20 years, senior strategist and a resident swing trader. Brandon Chapman. Brandon actually worked with us at TD Ameritrade as well. He's our CMT. He's actually our macroeconomics guy, our technicals and fundamentals. By the way, we're not just like one genre of trade. You name a genre of trade, whether it's swing trading, whether it's intraday trading, whether it's technicals, fundamentals, macroeconomics. Brandon actually wrote the book, specifically wrote the book for the CMT course. Steve Slim Miller, it's a 43-year veteran stock options and futures trader. Yeah, Slim actually started trading on the floor, okay, when the floor started trading for the Chicago Board Options Exchange back in 1973. Last but not least, Tony Rago. This is an intraday trader. NASDAQ futures. What does Tony do all day? Trades NASDAQ futures. So the first bonus to you, it's all the trading classes. Those are the trading classes. There are 7 of us, okay, working full time to develop those classes. Bonus number 2, we give you an all-access TheoTrade VIP membership. It's free. Okay. I know everybody looks and they go, 88 classes. You have 3 months access to TheoStream. In that 3 months, pick a genre of trading. Master it. Okay. Not only are we going to give you access for 3 months, we also give you access to our trading room. Our trading room broadcasts for 6 hours per day. I know that you can't necessarily watch that. Some people are like, I work for a living. That's okay. We give you access to it. We believe, okay, if you will, in just giving everything to everybody and not piecemealing this crap and selling you this and selling you that, okay? One size fits all, people. Here you go. We're going to broadcast 6 hours a day to you. You want to catch it? Great. If you can't, that's fine. You don't have to watch all day. You can learn a lot, though, watching all day because we provide real trade ideas. We trade live. Okay? We don't have, this is no holds barred. I trade live. Everything you just saw on the screen today, all the trades, those are trades that we actually texted out, use push notifications, including all these volatility spreads. We use text notification and push notifications, right? We have 5 distinct trading portfolios. We also have daily coaching sessions with timely topics and stocks, options, and futures. And this is probably the best portion, I think, of this bonus. We'll answer your email. We will answer your email. I will answer your email. Any of our instructors. If you need help, you can email us. We'll get back to you within 24 hours. It can't be like 5 minutes to go to expiration. You're on fire. Okay, the whole world's coming down. We'll answer your email. And people, I'm going to tell you right now, you think that's not worth $1,000 for 3 months? Because it is. 3 months. We'll answer your email. You have a trading question, fire it away at us. I don't say, I need help. I have a friend that has this position on. I don't want to hear that. Okay. Just tell me your position. Tell me what you're thinking. Okay. And we'll get right back to you. So we give you access to the chat room. We give you access to our instructors. We give you access to all the archives. We give you push notification. We have 5 trading portfolios. We give you access to 88 different classes. I'm not done. We also give you access to every indicator that we've ever built here. There's 59 proprietary indicators and scans. We have expected move, gravity points. By the way, gravity points. You want to see gravity points really quick? Come on. Come on. Why can't I show you gravity points in here? Right? Here's your gravity points. S&P gravity points. And people go, I have no idea what that is. These gravity points, watch them on an intraday basis. We'll literally come to a gravity point and rip off of it. You want to see this on a little bit of a longer window? That's gravity points, people. Gravity points are areas that we literally gravitate towards. I think you guys will appreciate it. Okay, we have Quantix, which, by the way, this cumulative tick indicator, I'm going to give you that one in just a minute. Just hang with me because I told you, at the end of tonight, I will give you, okay, Quantix in the cumulative tick indicator over here. We have next generation squeeze, Theo Quant trade setup, IV rank and percentile, complex position tracker, SPX expected move, unusual put options activity. It's at least $1,800 in indicators and scans. We do this because you need it. We do the classes and give you access to 88 classes because you need it. We give you access to us on email because you need it. We include everything you need to invest, everything you need to trade. We will give you classes. We will give you coaching. We will give you email access to our instructors. We'll give you a live trading chat room and live trade ideas pushed out to you, okay, when the markets are open. We'll give you indicators. We'll give you the scans. And we even built mobile applications so you can access us 24/7. It's everything that you're going to need to succeed. We built here at TheoTrade the Netflix for traders. Every genre of trade. You want to do pairs trading. You want to trade futures. You want to do swing trading. You're into technical analysis and fundamentals. We have the answer for you. Tonight, TheoTrade, it's $297 for 3 months. It's $297. That includes the live course this Saturday. Okay? And again, the live course is archived. I know it's short term. Here we are, okay, on a Tuesday afternoon. The course is coming up this Saturday. Good. Get ready. Okay? Get ready. Enroll for it tonight. Start watching some of the background information. You want to go right now to theotrade.com/risk. theotrade.com/risk. Okay, it's R-I, S as in Sam, K as in kick. Okay, it's theotrade.com/risk. We will have new monthly classes. So in the next 3 months, you're not just getting this one class. You'll have, again, class after class after class. You have a live trading chat room. We broadcast 6 hours a day. Okay, we'll give you access, though, to the mobile application. You can even play this stuff back at 2 times the speed. We give you every indicator. We give you text and push notification. We give you daily coaching sessions, okay? And we'll directly answer your questions. Now I'm going to top this, okay, with this. We're actually going to make this a completely riskless trade. Everything you need to start from absolute novice to expert. We'll even throw a money-back guarantee. By the way, the money-back guarantee, just so you guys know, there's 30 spots open for it, because I'll explain this here momentarily. Money-back guarantee. Trade with us over the next 3 months. If you're not satisfied, by the way, what's satisfied? If you're not happy, I don't care. You want to define satisfied? I'm feeling a little bit difficult right now. Listen, trade with us for the next 3 months. If you're not satisfied, just email us. Okay, provide us the details of your trades. If you're not happy, receive a full refund. That's it. Okay, why do we make it a riskless trade? I mean, it's $297, okay? Like, you know, people are thinking like, is this an introductory price? Not introductory price. By the way, I also want to throw this out to you. This is not a membership. Stop with that, because I already see the questions pouring into the chat room right now. People are, is this a membership? It's not a membership, okay? Why don't we do memberships anymore? Because people are scared of memberships. Fine, you don't have to do a membership. If after 3 months you don't love us, it's okay. We can part, okay? We can still hug. Wait, we're not allowed to hug anymore. We're not even allowed to touch each other without any type of like, you know, biohazard suit in any way, shape, or form. But you can send me a lovely email. How about that? All right? Is it safe? It's $297. And if you want to do another 3 months after that, it's $297. You want to do it for, you know, a month after that or 3 months after that, it's $297. Okay? And that's why we make it a riskless trade, because we want you guys to feel at ease. It's $297. Who cares? You know what? If you don't like us after 3 months, we'll just give you your $297 back. By the way, there's a stipulation. There's a stipulation on the money back guarantee. Here's the stipulation. I think that this is fair. You got to do 10 trades. Because if you're going to be unsatisfied, you at least have to do, you know, like some trades, 10 trades. You could follow my trades. Maybe you follow my trades, do 10 trades. I'm going to do a lot more than 10 trades in the next 3 months. Your initial account value has to be more than $2,000. You must follow our criteria. What I'm saying is, you cannot do 10 trades and make up your own crap. You have to follow our criteria. And you must provide real account statements. This ain't paper trading, people. Okay? Get in the ring, do 10 trades. If you're not happy after you do 10 trades, show us your account statement. Okay? Again, as I said, I'll still love you. And to get your $297 back, it's $297. Right now, we have over 4,000 individuals, okay, that are enrolled at TheoTrade. To lose one is not going to kill us, but we want every one of you to be satisfied. And that's why we do this. Okay? It's critical to me that you guys understand. We want every one of you to be satisfied. Okay? And we think you're going to be. That's kind of why we put our money where our mouth is. We do this tonight for the first 30 people. Okay? Why did we do it for 30 people? Why not do it for 300 people tonight? Because the bottom line is, how many of these trades can I possibly look at? Right? If you look at 30 clientele that are going to enroll tonight, 30 clientele, you're each doing 10 trades. We have to reconcile those trades. It's just a matter of size. There's just no way that we can, you know, look through, you know, 10,000 different, you know, accounts over there. We'll give you unlimited email mentoring as well. So we limit it a little bit. Send us your trades, $297. Okay, the riskless trade, it's not been available before, especially on this course. You want to know why? Because this course comes up this Saturday. Okay, this course comes up this Saturday. Get in now. There are 30 spots on the riskless deal. Again, there are 30 spots on that riskless deal. Now I'm going to answer a couple of your questions here momentarily. By the way, what our members are saying. Hey, just finished my first ever quarterly trading report and grossed 21% ROI. Thanks for all the help. Looking forward to your intraday course tomorrow morning. Just want you to let you know, Don, how much I appreciate him and what he does for us. The first time ever, my account's green. TheoTrade Access. This is everything that you get today for $297. I just want to make this clear. The Guide to Surviving and Thriving in Extreme Volatility. That class is live. And again, this class is live. It is March 7th. You're not going to find that in the archive because it hasn't happened yet. Okay? It's 7 a.m. to 12 p.m. Central Time. The first bonus, 3 months all access, pass. All access pass to our trading room, our archives, our text and push notifications, trading indicators, email support, daily coaching sessions. Bonus 2, we give you access to over 88 classes. There's swing trading and technical analysis, and well, I'll show you in a moment, including new monthly classes. Right now, what we're going to do, we're going to actually cruise over directly to the site. And the reason we're going to go to the site, follow me to this link for the cumulative ticks and quad indicator. You ready? Okay, TheoTrade.com/risk. Now, I actually want to pop up the site. Okay, and I'll throw the web address back in here so you guys have it. Make sure everybody's good. Okay, by the way, if you need to get a hold of us right now, support at TheoTrade, but even easier, we're here. Just come right in here, type in your name, okay? Type in your name, put in an email address, and start the chat, and you can start chatting with us. Okay, to enroll for the class, all you have to do is go to TheoTrade.com/risk, all right? Come here, click Add to Cart. The only reason I'm showing you the Add to Cart, okay, is I want to make you aware of everything that you receive over here. It's just billing information. But the reason I'm reiterating this, it is not a membership. It's not a membership, right? If you bill us and you're not happy after 3 months, we do not ever bill you again. And that's one of the most important things that I like to distinguish in here. There are 30 riskless spots left. We have just under 1,000 people on tonight. So it's TheoTrade.com/risk. Now, on the bottom of this page, and as I'm scrolling down because I want you to see it, on the bottom of this page, there's the quant, tick indicator for thinkorswim. So this is where you'll go ahead, this is where you'll go ahead and actually download that particular indicator. Everything you need to know about the time of the class, we will send you emails regarding everything. By the way, after you click Add to Cart and you enroll for TheoTrade, it will take about 10 minutes before it propagates a username and password. Give us at least 10 minutes because I'm going to tell you right now, I just clicked on there and there is a huge amount of web traffic that we're generating to our credit card site right now. So it's going to take probably 10, maybe 12 minutes at most before it actually propagates the username and password. After, you're in, and I want to show you this. This is TheoTrade, and then I'm going to answer a ton of questions. When I say this is TheoTrade, this is TheoTrade. This is actually what the site looks like. So when you hop into TheoTrade, first thing you do, you can kind of cruise over to, this is the member chat room. This is where we broadcast. It's like a TV screen, and we'll actually broadcast. You can see where I'm telling everybody here in this status line, Guide to Surviving and Thriving Extreme Volatility class, the next upcoming class. And what I was doing in here is showing you, these are just comments, These are comments from clients all throughout the course of the day, right? So, all right. Anyway, I'm just showing you guys a couple comments in here from clients throughout the course of the day. So feel free to hop in here, read some of this. Wait, on any given day, we have thousands, of traders. Here's Arthur. Another good day. Thanks again, Tony and Corey. I've been trying really hard to completely absorb the levels, Tony. It was easier today, and I think I'm about 70% of the way there. Need a little bit more practice, right? And I just want to scroll through here for a moment. And again, you read through the comments. I did Don Spy puts. They was actually talking about the trade that I did a little bit earlier today. closed the puts way too early, left a lot of money on the table, but that's not a bad thing. This person still made money. Okay. I missed the SPY puts. These people are actually talking. All right. Again, these people are talking specifically about the trades that we did today. And I'm spending a minute going through here because I want you to see all these comments are today. This is March 3rd, and this is right into the close. And again, we had just an astounding day today in our chat room. Okay. It's been great. Here, Hans. I like this one. Hans. It's nice just to have the experts to listen to and learn from and keep us company during the market day. TheoTrade gets 6 stars out of 5. I like it. Okay. So good going, Don. Again, I like showing this stuff. Okay. The wrist twist spreads, okay, are apparently very, RTS stands for wrist twist. It's good. Anyway, moving on from there. From here, I actually want to show you what, like people come into TheoTrade and they're like, well, where am I going to start? Where am I going to start? You see this little start here menu right there? This is what start here looks like. If you're an absolute novice, you got to start here. Options 101, options 201, options 301, order execution. We teach you everything for the novice and even the most extreme trader. If you're an extreme trader, when I say extreme, like you've had some experience before, come over here to like the member home. Any topic you can think of, any topic you want to talk about, probability of touching. Okay, you're like, what is probability of touching? You want to know everything there is to know. We built, an entire search engine. We built a search engine like Google for every single topic in here. Name a genre, probability of touching, Wednesday, August 9th. Okay, all right, Wednesday, the many applications for probability of touching. There's everything you're going to need in here. Then you want to see what the classes archive. I said there's 88 classes here at TheoTrade, right? 88 classes. And they're all different genre. There's options classes and option newbie classes, and then there's technical analysis classes and day trading and stock and futures and hedging, okay, and trend trading and mindset and pairs trading, okay? You want to see what they look like? Go to the option strategy. I'm actually clicking on it. These are all the classes in here. Sell premium, minimize your risk. Weekly options advantage, butterflies guide to weekly returns, okay, beginner's guide to ratio butterflies, the Greeks, strategy week, how to collect income being short, selling options for a living. Okay, black book spreads, guides to maximum edge trading earnings. You have access to every one of these courses from day one, literally from day one. With that, I'm going to come back now and I'm going to answer all the questions. Come right here, again, come right here to theotrade.com/risk. When I say I'm going to answer some questions, okay, look, I'm actually going to pull up literally questions in here. So again, the web address is right down here. I have general questions. Okay, I have general questions that I'm going to answer, and then I'm going to answer very specific questions, right? And I know some people, again, like Ed was asking, is this class going to be recorded? Absolutely, okay? First question that we always get, what do you really need to get involved here? You need a laptop and internet connection. I'm going to argue you don't even need a laptop. Just have, what, like an iPad, anything like that. Tablets are fine today because you could trade off of them. We have everything you need to get started from absolute novice to the most extreme. Okay, and we really mean that. Like we have everything to get started. The second question that always comes up here, is this a membership? It's not. I've actually mentioned that a couple times. We're not going to auto renew you. We're never going to bill you again. It's not a membership. If you want to do it after 3 months, and I want to make this also just abundantly clear so everybody kind of gets it, right? Tonight, it's $297. And if you're the first 30 people to sign up, it's just riskless, right? Number 3, TheoTrade, we archive everything. We understand you can't watch live. By the way, so there's something cool about the archive. When you archive it, you can watch it at like 1.5 the speed. You can watch it at like 2 times the speed. So you want to listen to me, I'm already fast enough, but you can listen to me at 2 times the speed. So instead of an hour session taking an hour, it'll take 30 minutes. Number 4, we're going to provide you to access to TheoTrade Mobile. You can watch the archives here in our website. You can watch the archives on your mobile device. You can watch the archives at 30,000 feet after downloading them like Netflix. Number 5, you can email us anytime you want. You will receive a response within 24 hours. Most of it's same day, but we say 24 hours, including trade-related questions. You want to ask me about a trade? It's okay. Don't be offended, though, because I'm going to tell people what I think of your trade. Good, bad, or indifferent. We will tell you. Number 6, you will gain access to every course TheoTrade has done in the previous 4 years. We will give you access to classes, coaching sessions, live trading sessions. All the archives are searchable. Name a trading topic. And I showed you a moment ago, we built like a Google. We literally built a Google for our archive. Number 7, all the trades that we talked about could be done inside of an IRA or retirement account. Minimum $2,000. You do have to have $2,000 to do this in the account, but that's it. And that's not my rule. That's not a TD Ameritrade rule. That's not a Charles Schwab rule. That's actually a FINRA rule. Number 8, at TheoTrade, we can help you get approved for options. You're like, wait, what? Well, options, you're supposed to have approval. You're supposed to have an understanding of options. And some people say, I can't get options approval. We'll get you approval. We actually have several major brokerage firms. Remember, I worked, of course, at TD Ameritrade. One of my best friends works at E-Trade. Another really close friend works at Charles Schwab. By the way, there are no other brokerage firms. Actually, there are. And we know them all. We know I have friends that work at all of them. Okay? 30 riskless trade spots are available. In fact, I'll tell you here in a moment because I don't think there's 30 spots available anymore. Listen, get results, take action, enroll for TheoTrade now. There's just no risk at all to you in effectively doing this because we give you a riskless trade. You don't like us after 3 months? Okay? We'll still love you. We'll give you your $297 back. It's theotrade.com/risk. Again, theotrade.com/risk. Now, I'm going to answer some of the questions out of the chat room, okay? I also wanted to throw a couple of more of this. Some of our members are saying, and I love this one. I love this comment. By the way, you guys are rocking it. It's very impressed. It's really refreshing to have you guys putting this together and sharing knowledge and not upselling everything and turning and burning your customer base. You've got a customer for me in life. For life. I can't even speak. You've got a customer for life in me because of this approach. And I'm sure I'm not the only one. It's from David. I just like that one because we want you guys to know we give you everything at one place at one time, right? And it's important to me that you guys know that, all right? Matthew W. All right, this one actually looks like it came from Facebook. Don is the most knowledgeable person I've ever heard in my over 50 years of stock investing, and I've listened to many. His knowledge of how the markets work is like sitting next to a finance PhD. Highly recommend learning what this man has to say. I'm very impressed with TheoTrade. I've studied under stock coaches, various trading intellects and strategy intellects, different trading plans. I've not come across anything as good as what I'm seeing here. The people at TheoTrade are very helpful and extremely knowledgeable. I'm looking forward to this association for many years to come. And I wanted you guys to have a bit of that. Again, I wanted to throw up the web address one more time, a couple more quotes over here. It's theotrade.com/risk. In fact, I'll tell you what I'm going to do. I'm going to answer some general questions now, some general questions directly from the chat room, which have obviously come up here. I'm also going to throw up, once again, the web address where you guys are enrolling for this. Let me answer, okay, a few questions, and well, we'll get this done here. All right. Why does IV decrease, okay, but inspected move increase as you go down the chain? Yeah, that's actually, that's very normal. Implied volatility, okay? When risk is extreme in the here and now, implied volatility, okay, is higher in the here and now, meaning risk is prevalent right here, right now. So as you go further out in time, though, more time allows, okay, more time for stock price movement. So effectively what you got is the further you go out in time, the more the stock has ability to move, okay? But volatility actually does subside. And that's a dynamic we do talk about quite extensively here at TheoTrade. And it's actually a really important dynamic as well. All right. All right. I like the next question. How do you hedge? Okay. Do you hedge using this strategy? So I believe that what we are referencing, okay, in this one is how do you hedge like stock? So there's a bunch of different ways to hedge stock positions. You can use options to do it. You can use other stock positions. You can use futures contracts. Okay. We teach an entire, we have an entire area inside of our class archive specifically for hedging strategies. What I showed you tonight, like with the risk twist spread, yes, that is absolutely a hedging strategy, as is the VIX volatility spread. Those are designed, okay, to mitigate, if you will, downside. Okay, and I got to tell you, right here, right now, you got to make some tough decisions. I mean, you got to make, when I say some tough decisions, you got to make some tough decisions as to what you're going to do with your portfolio. And I don't mind saying this. I'll help you do that. Okay. I will absolutely help you do that. All right. By the way, I want to thank, again, as we have this riskless trade going on right now, I want to thank Kenneth K. from Washington, John S. from Oregon, Thomas S. from North Carolina, Praveen A. from Washington, Michael P. from New York, Stephen T. from Texas, Ryan H. from Minnesota, Lorley from Florida, Kim from Nevada, Gerald from Virginia, Lonnie from Texas, Bernard from Georgia, Rachel from North Carolina, David from Minnesota, and Pradip from Ohio. Thank you guys very much. And please, I urge you, come into the chat room first thing in the morning. By the way, tomorrow's Wednesday. I kick off the chat room almost every single trading session. We start live 8 minutes before the bell goes off. So if you're on Eastern time, if you're on East Coast time, we start live at 9:22 Eastern Standard Time is when TheoTrade goes live in the morning. By the way, Dennis K. from Florida, Edwin N. from, looks like Maryland. Hopefully I got that right. I'm stepping about 20 feet away from my computer monitor over here. All right. Last question, and then I got to wrap up. We've gone over here tonight. That's okay. Somebody said, I've traded options, but never spreads. Okay. Lots of services explain how to open, but never how to close. Okay. And you just said no stops are required. Okay. So how do you know when they're closed? So I love this one. It actually came from looks like a gentleman by the name of Sid. Sid, hopefully you're still with me over here. Closing it is everything. We spend a lot of time in the pre-flight, like in how to get into the strategy. But what you'll find, successful trade isn't necessarily about opening it. It's about execution out of the strategy. Many of the strategies that we use here at TheoTrade are percentage return execution upon the close. By the way, thank you. Sid's actually still here. Thanks for chatting in. Their percentage execution. And I'll give you an example, like the in-out spread. One of the key metrics of the in-out spread, we will give you very definitive guidelines of the percentage return you have to hit. And you'll understand in going through that class that you have to hit the percentage return before executing out of it, both for the win side and the loss side. Okay, and you'll get it from there. Then you get into crazy strategies like risk twist. When I say crazy, a risk twist, you pay $1.80 for it. It can make $10. Who cares if you lose the $1.80? You could lose $1.80 once. You could lose $1.80 twice. You could lose $1.80 3 times. Who cares? Because in the 4th time you do the strategy, it hits the grand slam home run. That's what risk twist spreads are about. It's about getting the trade modeled correctly, paying $1.80 for something that could be worth 10, 12. We actually had a client the other day that closed out of a risk twist for $16 credit, a $16 credit in the spiders. Okay. So I hope, Sid, that answered some of your question. You will see much more like, and again, Sid, I'm explaining this as if it were the in-out spread because I believe that's probably where you want to start. By the way, Richard O from South Carolina, thank you for enrolling tonight. Listen, I know that I've gone way over in time. I want to thank everybody for joining us. Again, it's theotrade.com/risk. Please join us tomorrow morning. Join us in the chat room. Okay. Get accustomed to a few things that are going to go on. You're going to feel, all right, a little uneasy getting in there initially. You get thrown into the deep end of the pool because it's a volatile marketplace. But I'm telling you, what we're doing right now, and specifically what we're going to be doing this Saturday, the guide to surviving and thriving in extreme volatility, it's going to be well worth your time. Thanks, everybody, for joining us tonight. Have a wonderful evening. Bye-bye.